Now, what is my practice worth? How do we value a veterinary practice? Veterinary practices are typically valued utilizing an income approach method. And why is that? There are multiple methods in valuing a veterinary practice. There's the market approach, which means you look at similar practices of similar size and similar profitability, but it's often very, very difficult to find practices that are similar. So that approach doesn't work. And then there's the asset approach. But that doesn't really take into account to the goodwill. And a lot of veterinary practices have a lot of goodwill. So that brings us back to the income approach. So, how do we value your veterinary practice? We value your veterinary practice by looking at its overall profit. Value equals profit. How do we calculate profit? We first look at the income statement, and then we calculate what we call the net adjusted income. We go back through the income statement and we adjust things such as owner's compensation, non-recurring expenses like large equipment expenses that should have been capitalized on the balance sheet, practice vehicle, personal expenses that are in the net income typically that are not really business expenses. Interest, amortization, depreciation are all adjusted for. And we spend a lot of time going through the financials and looking for these one time expenses that really wouldn't be necessary for the practice moving forward. And through that, we're able to find what we call a net adjusted EBITDA number. Then it comes to, well, how much can I sell it for? How much can you sell it for? That depends on who's buying. Whether you're selling to a corporation or you're selling to a private buyer, there can be a pretty large difference. We use something called a multiple. A multiple is the inverse of the capitalization rate. The multiples for corporates, typically in this market, can be anywhere from 8 to 14. And that means they take your net adjusted EBITDA number, that number we calculated by taking out all those non-recurring expenses and adjusting for things that the practice won't need moving forward, and we multiply it by that number. And that's a pretty large number when you multiply it by 8 to 14. If you're selling to a private buyer, that value typically is more like 5 to 5.25, so a little bit less. And again, the time of the year, the economy, all of those things play a role in how much risk a buyer is willing to take. And that multiple is a measure of the risk. And that sums up how we value your veterinary practice. There are so many mistakes that we see that can what we call derail a sale. What are things that can come up that, hey, I just got this great offer, but we didn't make it to the closing table? And why? What kinds of things come up? One is legal issues, things such as DEA violations and OSHA violations. Those can be quite common. Number two is poor financials. We see a lot of poor financials. That means not well organized and not well categorized. For example, drugs and medical supplies need to be drugs and medical supplies. Equipment needs to be equipment. And we see a lot of personal expenses being run through the business, boats, skis, horses, trips to overseas. People love to have those potential write offs for their taxes, but what they don't realize is that these types of things make it difficult to really find out what the true expenses are and what is personal. And many buyers are turned off by excessive amounts of personal expenses or expenses that they can't explain. Another one is not a current doctors on staff, maybe perhaps doctors not wanting to stay on if a corporate buys the practice. Many doctors maybe perhaps want to go out on their own, they want to start their own practice, or they want to have part ownership. And so having your doctors on board is really important if you want to sell, because having doctors walk away really is going to affect your future income, and that can really cause your sale to fail. Another common reason is rent issues. When I say rent issues, what I mean is, do you own the property or do you rent? And if you rent, is that lease assignable to somebody else? Can you assign it? Number one. And number two, is the rent going to go up for the buyer? And number three, how long can they rent the space? Many corporate buyers want 5-year leases up to with 3 renewals. Nobody, whether a private buyer or a corporate buyer, wants to buy a practice with 2 years left on the lease. So that's a very important question to ask: is, do you own it or do you lease it? How long is your lease? What are the terms as far as assigning the lease? And what is going to be the rate once I sign it? Furthermore, other things that can derail a sale can be perhaps record keeping, poor quality medical records in the practice, which can relate to poor quality production numbers in the software. Um, just in general, having poor quality equipment, having a staff with a lot of turnover can be very scary as they go through the sales process. So those are just a few things we see that can hold up a sale. So just remember, check your DEA and check to make sure you don't have any outstanding IRS liens. Um, Make sure that your doctors are on board, or at least get a sense that your doctors are on board for selling. Check into your lease terms. If you own the property, really think through how much rent you want to charge, and is that rent at fair market value, and have your financials refined and looked at. I mean, by having a CPA or a veterinary valuation analyst such as myself look at your books, perhaps see where things could be better categorized and cleaned up, would really make your practice look a lot better to a potential buyer. When it comes to choosing a broker, you want to have somebody who really believes in your mission statement and in your practice and in your legacy. Someone who is going to help you find the buyer that's going to carry on your legacy and continue to have the medical standards that you have in your practice. It's very, very important to have a broker who is a certified valuation analyst. That means that they have gone through a class called NACVA and ACVA, and they are certified to do a proper valuation, because there's many valuations out there that are improperly performed, and then you end up leaving money on the table. You also want a broker or an agent who you can communicate well with, that you have a good rapport with, that you can easily get a hold of, and that you feel comfortable with. Because many of you only sell your practice once, and you want the right representative when you're going to sell your practice. Also, experience in the field. Myself, I'm a veterinarian. I've been a practice owner for over 28 years, but I've also been through the sales process myself. And many of us have that personal experience to be able to give sellers our insight into things that they could do to improve the way the transition is going to happen, and also the price they're going to get at the end of the day. When you're thinking about selling your veterinary practice, it is recommended to start thinking about preparing at least 5 years in advance. Many people wait until it's too late. They haven't saved enough money. They really need the value out of that practice to retire. And at that point, if the practice isn't worth enough, then they can't retire. So it's really important to engage an exit planning advisor such as myself, who can help you First of all, look at where your practice is valued today and help you make the proper changes so that you can be ready for your transition 3 to 5 years from now. We're just going to talk about how to know what your practice is worth. Practice value equals profit. In a veterinary practice, there are 3 different methodologies with multiple subcategories of how to value any type of professional business. There's the market approach. When you look at comparable sales of comparable businesses and come up with a number that way. The second is the asset approach, where you're actually valuing the assets. And then the third is the income approach. And veterinary practices are valued based on the income approach because that is the most reliable and accurate methodology. With the asset approach, there's a lot of goodwill in veterinary practices, as we know. And the asset approach does not take into account the goodwill. And with the market approach, it's very difficult to find any 2 veterinary practices that are the same, whether it's location, number of doctors, medicine practiced, equipment. There's so much variation that it's extremely difficult to find similar practices. So we rely on the income approach when we value veterinary practices. We do calculate this by adjusting the net income. It's called the net adjusted EBITDA number, which equals your profit. And we look at things that will not be necessary in the future operations of the practice, such as a vehicle that's your personal vehicle, perhaps a few trips to Europe that you put in your expenses that were non-business related, depreciation, amortization, interest, all of those expenses are removed, and we come up with this net adjusted EBITDA. So again, practice value equals profit. Practice price, how much you're going to get for your practice, depends on what someone's willing to pay. And that's going to come up to, is it going to be a private sale or a corporate sale? Corporate sales typically offer a much higher multiple of that net adjusted EBITDA because many corporations are very well funded, whereas private buyers typically pay a little bit of a lower multiple. The multiple equals the risk, right? And so the lower the multiple, the higher the risk. And depending on the time of year, what our current economy is looking like, you may or may not get a higher or lower multiple.